You've probably seen a Club Pilates or a Stretch Lab pop up in your neighborhood. Well, they're part of Xponential Fitness, one of the biggest fitness franchisors in the entire world. And while their studios seem to be absolutely everywhere, their balance sheet, well, it tells a pretty shocking story. Today, we're going to unravel the puzzle of how a company this big can post such a massive loss and what it really means for their future. And yeah, this is the question at the heart of everything. With over 3,000 studios, how on earth does a company that seems so successful report a staggering $54 million loss? I mean, it just looks like a huge red flag. But the real story, as always, is buried deep inside the numbers. You know, a report from HDIN Research frames it perfectly. This isn't really a story of a failing business. It's more like a story in three acts. You've got a profitable core, these massive paper losses, and then a complete financial reset. Let's break down what that actually means. Okay, so first up, let's decode those financials. We're going to peel back the layers of their annual report to figure out what is really going on under the hood. And there it is, the headline number, a net loss of $53.7 million. Now, for any investor, that is a massive, blinking red flag. But with a company like this, that bottom line net loss, it is rarely the whole story, right? So look a little closer. That huge net loss kind of vanishes when you look at their operating profit. That's the money they actually make from, running their business. And that number was a positive $20 million. So this is our first clue. The day-to-day business is actually making money. The problem is hiding somewhere else. And you can see the business is getting healthier just by looking at where its money is coming from. See, they're shifting away from selling equipment one time, and they're focusing on stable, high-margin franchise fees. That kind of recurring revenue now makes up over 60% of their income, and that is a much, much more sustainable model for the long haul. So if the operations are profitable, where did that huge loss come from? Well, it came from these one-time charges that have nothing to do with the day-to-day business. Things like restructuring debt, writing down the value of assets, and paying off legal settlements. These are what we call paper losses, and they completely wiped out their operating profit on the final report. For investors, this right here is the key metric, adjusted EBITDA. It basically strips out all those one-time costs and other non-operational stuff. And Xponential's was a very healthy $111.8 million. So the crucial takeaway is when you look past all that noise, the underlying engine of the company was actually performing pretty strongly. So the underlying business is strong, but what is that business exactly? Well, it's a whole collection of fitness brands, and the company's health depends completely on them. Let's take a look at the core players. Here they are, the Big Five. Club Pilates is the undeniable superstar here, with over 1,400 studios, making it the main pillar of the whole business. Then you have stable growers like Stretch Lab, an international growth engine in BFT, and a solid niche leader in Yoga 6. Now, Pure Barre is the largest in its category, but its growth has been sluggish, which kind of highlights that not every single brand is firing on all cylinders. And this map, wow, it really shows you the scale of their dominance. Over 2,600 studios just in North America. You can see these dense clusters in California, Florida, and up in the Northeast. This is not just a handful of gyms. It's a massive national footprint that gives them huge brand recognition and a really solid foundation to build on. But that growth engine is hitting some pretty serious speed bumps. Let's talk about the cracks that are starting to appear in their big expansion plan. And this number, this is a big one. As of the end of 2025, an estimated 30% of the franchise licenses that have already been sold in North America are inactive. They're behind their development schedule. And that means hundreds of planned studios are just stuck in limbo, which is a major drag on growth. So, why the logjam? Well, it was really a collision of three major forces. First, financing pretty much dried up for new franchisees. Second, inflation pushed the cost of building a studio to over $500,000. And finally, regulatory inquiries in key states like California put a total freeze on selling any new licenses. It just created this massive bottleneck in their growth pipeline. All of this brings us to the final and maybe the most critical part of this story, the company's incredibly bold move to completely reset its financial structure and chart a whole new course for the future. To tackle its challenges head-on, Xponential took out a massive new term loan for $525 million. This one single move redefined their entire balance sheet and really set the stage for the company's next chapter. But this new debt, it's a huge trade-off. It's a classic private equity-style move. So on one hand, yeah, they cleaned up their balance sheet by paying off a lot of older, more complicated loans. But on the other hand, this new loan comes with a crippling interest rate of nearly 11%. That means they now have an annual interest bill of $53 million. That is a massive weight on their cash flow. Now, beyond all the financial maneuvering, they're also looking to technology to get an edge. The plan is to use AI to both personalize workouts for members, and this is crucial to help franchisees run their studios more efficiently. And that could really help prevent the kind of operational issues we've just been talking about.
And so we end right where we began, with a really critical question. Xponential has cleaned house, it's refocused on its core brands, and it's reset its finances. But in doing all of that, they've taken on a heavy new burden. The road ahead is going to reveal whether this high-stakes gamble has truly fixed their foundation for long-term success, or if they've simply swapped one set of problems for another. Our deep dive today was based on an analysis by Jane, a senior analyst at HDIN Research. If you want to go even deeper, you can find their full report on their website. Thanks for tuning in.